Amrita Sen, Commodities analyst at Barclays Capital. Welcome to the programme, Amrita. Good to see you. Now, since August, as we say, stocks are down pretty flat. Copper's well down. But oil is still holding its own and has been rising, barring a few day-to-day fluctuations. Now, what is the main reason for that?
I think if you look at the fundamentals for oil, they have been remarkably resilient. Demand, okay, there are fears about Europe, but they really haven't fallen that much. It's really been the supply side, whether it be Libya and then just underperformance right throughout the world. And you've just had such a confluence of factors that has effectively meant inventories are really, really low at the moment.
Now, you talk about the three Ps, pipelines, politics and psychology, and the Seaway pipeline still dominating market sentiment. Can you just give us the reasoning behind this reversal? Because it's quite fascinating and it took quite a few people by surprise.
No, absolutely. I think one of the things you've seen is Brent Crude outperforming WTI right through this year. And the main reason has been that there is a lot of US production, a lot of Canadian production coming into WTI's delivery point, Cushing. And this pipeline effectively will mean that now you can take Cushing crude out, Cushing was landlocked earlier, to the Gulf Coast, and the refineries can refine it. Suddenly, WTI is not so-called oversupplied anymore, and then that's why you've seen a huge rally in prices over the last week.
Has that been overdone, do you think, that rally, notably in WTI?
I think you need to still be cautious because it's one pipeline that's being reversed, and if you look at the other pipeline projects that were supposed to come online, they've all been cancelled because of politics, and that's why we titled the piece that we did. A lot of environmental lobbyists, and as a result of that, yes, there can be some relief in 2012, bit of 2013. You need a lot more pipelines to really alleviate the problem.
No, it's been interesting, hasn't it, the spread between West Texas Intermediate and Brent. Is that narrowing now? Might we see a bit of parity in the next few months?
I think you could see a bit more in terms of moving towards parity. I'd still not say that we could reach parity because you still need rail to move the crude around, and the rail economics are not cheap. You need about $10, $12 for it to be economical. As soon as you get that, automatically the spread will remain fairly wide.
Now, going back to the other P, politics. Is the bearish sentiment in Europe really outweighing the pretty solid US data, frankly, by and large?
Oh, yeah, totally. I mean, I think just the fear that something really, really bad could happen, hence demand could fall, has been the main reason why prices have been so subdued. I mean, we reckon, given especially the geopolitical backdrop and so tight a fundamental backdrop, prices could have easily been around 150 this year.
And what about the psychology then, the threat of a global recession really weighing on traders' minds?
Oh, absolutely. I think that's why, like you said, oil has outperformed because the fundamentals still kind of win at the end of the day. But that is going to be the main reason or the key reason that keeps a cap on prices even next year.
And what about Iran? What about Libya when we're talking about geopolitics? I mean, is that a real concern? I mean, Iran, of course, such a big player in it.
Oh, yeah, completely. I think Libya, slightly better, coming back slowly onto the market. Iran's the key, and I think Iran's going to be the biggest threat for next year. Israel-Iranian tensions with the US troops pulling out of Iraq, that airspace is now available if they were to kind of attack. And yeah, 3.5 million barrels per day of production from Iran. They control a lot of the Iraqi oil pipeline politics as well in that sense.
Sure.
And the Strait of Hormuz, which is about 18 million barrels per day of transit. So yeah, lots to look forward to for next year effectively.
And so price predictions very briefly. When we're sitting here, no doubt we shall over the next 6 to 12 months. Oil price in 6 months?
I reckon it's around similar ranges, $115 for Brent, not too high. If we suddenly see something better come out of Europe, then I think we can push ahead of like 120, 125. But other than that, 115 is our target.
Amrita Sen, always good to talk to you. Thanks very much indeed for joining us. Amrita Sen from Barclays Capital.